Today we're going to talk about accounting for partnerships. So the first thing we need to look at is really what is a partnership. And a partnership is an unincorporated association that's going to have two or more people that decide to go into business together. They are common in small retail and service businesses, and there are a lot of professionals that have partnerships that include physicians, lawyers, accountants, and different people like that. So in looking at these partnerships, I want to go back and just kind of review some of the features that you have learned in the past that dealt with sole proprietorship. So, a sole proprietorship is one owner. It has a limited life. There is unlimited liability, which means that the owner has all of the liability on them. They're taxed on their personal tax return just by filling out a Schedule C. They do have that capital account, which is their residual value and what their ownership value is in that particular company. And then they have a withdrawal, or what we call a drawing account, when they take money out of the business. Now, partnerships are very similar to what we see in sole proprietorships. That difference that we see is going to be one that, we do have more than one owner when we deal with a partnership. So when we look at those characteristics of the partnership, and as I said, they're very similar to what we had for the sole proprietorship. It is a voluntary association. That means that two people have come together and voluntarily decided that they would like to start a business. This can, and they would have a partnership agreement. The partnership agreement could be in writing, but the partnership agreement also could just be a verbal partnership agreement. I will say that it is better to have a written contract because it is just better in the long run because it spells everything out. It gives you names, how much was contributed. It gives you any rights or duties that the partners may have. It lets you know what you're sharing in as far as income and losses. What is the withdrawal arrangement? What happens if we have a dispute? How do we, resolve that dispute? It looks at admissions or withdrawal procedures from the partnership. It also looks at what happens if a partner dies. Now, all partnerships, just like sole proprietorships, have a limited life. If a partner leaves the partnership or if a new partner comes into the partnership, the old partnership has ended and you have to start a new partnership. Just like a sole proprietorship, there is unlimited liability, which means that each partner has a liability for what happens in that particular business, and they're liable for the debts of that partnership. So if one partner decides to make a contract signed off on with the partnership's name, then the other partners are liable to making sure that that contract is put into force and make sure that that contract is met. For as far as taxation goes, it still passes through to the individual owners. However, you do have to fill out a partnership tax return, which is a Form 1065. Now, with this return, there's no money due for that return. You would get a K1, and each partner would get a K1 explaining how much money had been made percentage-wise for that particular partner, and then that would go on their personal return. Let's see, other items that we see, there is the co-ownership of the property. So property assets are owned jointly by all of the partners in a business. Other things that we look at is you are going to have multiple capital and drawing accounts because each individual partner will have a capital account and each individual partner will also have a drawing account. So it works very similar to what we see in a sole proprietorship, but we do have multiple accounts that we will be looking at. Now, there are some different types of organizations that do have partnership characteristics. So we have our limited partnership, which can be signified as with LP or LTD in their title. And with this, the partners are split between general and limited partners. In a regular partnership, you all have general partners, so everybody is liable. Underneath this limited partnership, the general partners are liable for everything, but the limited partners do have limited liability. You also have a limited liability partnership, which is an LLP. All partners are liable for debt in an LLP. However, partners are not liable if another partner has a malpractice suit against them or there's negligence filed against that particular partner, then the other partners would not have liability for that in a limited liability partnership. Another type of business we see is an S corporation. This is a corporation that has fewer than 100 owners, and they can elect what we call subchapter S status. They have to fill out a special form with the IRS within, I believe, 3 months of incorporation to state that they would like to be in a sub S corporation. It does have flow-through taxation, just like your partnerships do. So the difference with the S Corp is the self-employment tax. With the partnerships, they have self-employment tax associated with them. The S Corporation, they do not have self-employment tax associated with it. And your owners are going to be your shareholders, not partners, and they actually can be employees also, where that's not true with partnerships. With partnerships, you cannot be an employee. And then you have the LLC. So an LLC is a limited liability company. They're very popular right now. It does limit your liability. And the taxation is really going to depend on how you check the box with the IRS. Because as far as the federal government is concerned, LLCs don't really exist for taxation purposes. They are a state creation and they exist for state purposes. And so the LLC then would have to go in and choose, if it has one partner or one member of it, it can choose to be a sole proprietor. It can choose to be an S Corp or a regular corporation. If it has more than one owner, so 2 or more, it could be a partnership and be taxed as a partnership, or it could be taxed as a corporation or S corporation. So those are some of the things that we look at with that. With partnership, the different accounts that we are going to be looking at, you're going to have your capital just like you did with a sole proprietorship. The difference is that each owner has a separate capital account. Your capital account when you start a company is going to be net of any liabilities because you are able to put property into the partnership that has liabilities attached with it, and then the partnership would get the asset and the liability, and so that net amount is what would be in that capital account. Now, assets and liabilities are going to be recorded at their market value at the time that they are contributed to the partnership. So it's not looking at the basis that the owner has in it, it's looking at what is the fair market value at that particular point in time. When we look at net income or loss, this is something that is going to be allocated to each partner's capital account according to whatever the partnership agreement looks at. And then we have our withdrawal account or our drawing accounts. Each owner is going to have a separate drawing account from when they take money out of that particular business. When we look at this partnership income or loss, partnerships are going to be very similar to those sole proprietorships where partners are not employees. Partners are simply owners. The income and loss, however, instead of it just being one owner and all the income goes to one owner, it has to be divided into each individual partner's capital account. And this is done through several different mechanisms. The partnership agreement can state that it's a stated ratio, that one partner, collects 40% of profits, the other one maybe collects 60% of the profits. You could have a division for profits that's different than the division for losses also, but all of that would be in your partnership agreement. Division of profit and losses could also be done based on what your capital balance actually is, and so you'd have to look at your capital balance, you'd have to come up with a percentage of what one partner has to the total capital balances and split the profit that way. It also could be done based upon what services the partner has provided, the capital and stated ratios. So it could be a combination of all of that as well. Now, what happens when we have a change in partners? Well, any change in partners is going to dissolve the original partnership. So therefore, that partnership will no longer be in existence, and a new partnership agreement must be started. And this is if you add a partner, if a partner withdraws from the company, if there is a death of a partner. All of these things will dissolve the original partnership, and a new partnership agreement must be created. So if we add a partner, why would we add a partner? Well, one person could purchase an existing person's or existing partner's share in the business. Somebody decides they don't want to be in the business anymore and they sell their part of the business to someone else. It could be that we need more capital, and so we invite new members in to invest in the partnership. We also have partnership withdrawals. So if a person sells their interest to a new partner, they would no longer be in the business. They can also leave the partnership through just deciding that they're ready to withdraw from the business. They don't want to be a part of it anymore. Nobody else is joining the business. They're just ready to get out. And so then it could be a withdrawal of cash or other assets at that time. And then with the death of a partner, we really have to look at what the partnership agreement states, because there really should be a provision as to what happens with that partner's interest. It could be left to a spouse, it could go to their estate, and then go through. I mean, there's just lots of ways that this could be handled. Or it could be that the other partners would buy out that particular partner, and then the business could, continue, but they would, no matter what happens here, they would have to start a new partnership agreement. Now, what happens when we get ready to liquidate a partnership? There are actually 3 steps to partnership liquidation. So we decide that we don't want to be in business anymore. We would have to do a gain or loss on the liquidation, and it had to have to be allocated to the partners using the income loss agreement. We would have to make sure that we pay all partner liabilities, and then we would distribute any remaining cash and assets to partners based on their capital balances. Now, what happens if when we get ready to liquidate a partnership, one or more partners has a deficiency in their capital account? Now, what does that mean? It means that they have a negative balance in their capital account. That partner would then have to pay cash back into the partnership because they've taken too much out of the business. And so they would have to close that capital deficiency before we could liquidate the partnership.